Rightmove has just confirmed what many in the property world feared. Asking prices in the UK have dropped by 1.8% this November. That may not sound dramatic at first, but this is the biggest November decline in more than a decade. And when you dig into the numbers, it reveals a market that is quietly shaken. What's driving this fall? A growing wave of budget uncertainty. Talk of a mansion tax, potential capital gains tax on primary residences, and a serious shake-up of stamp duty is spooking both buyers and sellers. Today, I'm going to walk you through what really happened, why the market is reacting so sharply, and, most importantly, what you should do right now if you own property or are thinking of buying. Rightmove's data for this month comes from a huge sample. Around 85,000 asking prices. That gives the drop real weight. This isn't just an isolated blip. When that many sellers simultaneously lower expectations, it sends a clear message. Asking prices often act as an early warning system. They move before sales do because they reflect how much sellers think they can get, not just what they did get. A drop like this tells us that sellers are increasingly testing the market from a lower price point, and buyers are paying attention. There are two big forces behind this. First, the rumor mill around next week's budget is swirling. Speculation is running wild about potentially massive tax changes. Second, inventory is high. More homes for sale means sellers are competing harder, and many simply can't afford to wait forever for a buyer at their previous target price. Let's talk about those budget rumors, because they matter a lot. One of the biggest ideas being mooted.
Let's talk about those budget rumors, because they matter a lot. One of the biggest ideas being floated is a mansion tax, effectively a new annual levy on very high-value homes. Some reports suggest anywhere from £1.5 million up to £2 million could be the threshold, and that the tax could take the form of a percentage on the total value or just on the portion above the limit. That's not a small tweak. For people owning prime London property or expensive second homes, it could significantly increase their annual cost of ownership. That creates a serious incentive to sell, or at least to negotiate more aggressively on asking price, because holding on to a property that's expensive to own year after year suddenly looks less attractive. Then there's the talk of capital gains tax, or CGT, on primary residences. Today, when you sell your main home, you typically don't pay CGT, thanks to private residence relief. But some of the speculation suggests that could be scaled back for very high-value homes, or perhaps limited for those who own multiple properties. That's political dynamite. If it goes ahead, some owners who expected to sell tax-free may find themselves facing a hefty tax bill. That could fundamentally change the decisions some people make about when or whether to sell. On top of that is possible stamp duty reform. Some insiders think stamp duty could be scrapped or radically restructured, replaced by another form of property tax. There's talk of reducing upfront stamp duty for lower-value transactions, but introducing an annual property charge for more expensive homes. That could shift the economics of property transactions dramatically. Buyers and sellers would judge deals not just on the purchase price, but on the cost of holding the property long-term. If replaced with a generous annual tax, that could reduce the immediate transaction tax burden, but potentially penalize those who keep very expensive homes over years.
Now, those are just rumors, but in property, rumors carry outsized weight. The fear or possibility of change is enough to change behavior. We're not just talking theory. Agents and homeowners are reacting already. Some sellers are cutting their asking prices to preempt a budget shock. Some buyers are holding back in case rules favor them after the budget. And lenders, still digesting it all, are watching very closely. So how likely are these changes? The truth is, it's a mixed bag. A mild annual tax on the very top end is probably plausible, enough to make headlines but not to completely upend the mid-market. Lawmakers are always looking for revenue, and property is an obvious target, but political resistance will be fierce. A blanket property tax on all homes is much harder to deliver. As for CGT on primary residences, targeting only very high-value homes makes sense politically because it hits fewer people but still raises money. Fully removing stamp duty overnight without replacement is the least likely. It's hugely unpopular and risky. More likely is a compromise, some reform, some relief, phased in over time. With that uncertainty sloshing around, it's worth thinking in scenarios. In a soft scenario, we get a limited annual tax on very expensive homes over, say, £2 million. But CGT relief on primary residencies largely remains, and stamp duty stays in place, but is modestly tweaked. In this world, the market would calm down once the budget is announced. High-end demand might soften, but for most homeowners, little changes. Sellers in the top tier might lower their expectations, but volumes would stabilize. If that's what actually happens, the best move for you might be to hold, but price carefully. Don't list at 2021 level fantasy prices. If your mortgage deal is coming up for renewal, talk to your broker now and run the numbers.
In a transitional scenario, stamp duty is restructured. Lower upfront costs for many buyers, replaced by a modest annual charge for more expensive properties. CGT is tightened for prime homes, with only limited grandfathering. That could prompt a surge in sellers before the new rules kick in, a so-called pre-budget rush. Then things would settle into a new rhythm as more people adjust. For homeowners, that means acting sooner may make sense, but not rushing blindly. For buyers, there may be real opportunities to negotiate or lock in under the old rules, especially on larger homes or in markets where sellers feel exposed. For investors, this could reveal one-off moments where motivated sellers are willing to transact. In a hard case, the Chancellor surprises with a very aggressive annual property tax, hitting homes well below £2 million, combined with major restrictions on CGT relief. That would be a shock. Some owners with high mortgage costs could decide to exit. Listing volumes could jump sharply, especially at the top end. The market would face serious repricing risk. For buyers, valuations would need to be rethought, especially for buy-to-hold strategies. If you own, you'd want to model the worst-case carrying cost now. If you're buying, you'd need to be very confident about long-term fundamentals. Given all that, what should you do right now? First, don't panic, but don't ignore the risk either. If you're a homeowner with a fixed-rate mortgage coming to an end in the next year, now is the time to run new models. Ask your broker for what-if scenarios that include potential tax changes. Get a sense of what your after-tax proceeds would be if you sold now versus after the budget. If the new net sale price still meets your goals, listing soon might make sense. If not, you may choose to wait, but be ready. If tax changes land, the selling window could tighten or open sharply.
If you're thinking of buying, take a conservative approach. Assume mortgage rates stay where they are or go slightly higher in the near term. Do the math for buy-to-let deals, assuming 5 to 6% rates. Stress test your cash flow, including tax risk. Use this period of uncertainty as leverage. Some sellers already feel squeezed by the rumors. You may be able to negotiate better if you're ready with cash, mortgage approval, or a solid offer. If you're a landlord or investor, now is a restructuring moment. Pull out your portfolio and run worst-case scenarios. What happens if holding costs rise because of a new tax? What if capital gains relief disappears for some properties in future? For properties that are already marginal, you may want to consider selling before a tax change or refinance aggressively now, locking in capital or debt on favorable terms. On the flip side, for properties with very strong fundamentals or yield, there may be a unique opportunity to double down if other less confident landlords decide to sell. Here's a simple checklist to apply today.
Model your new mortgage or remortgage based on current interest rate assumptions. Model your selling scenario both before and after tax change. Talk to a tax advisor if your property is in a band that could be heavily affected. Run cash flow stress tests on potential buy-to-let deals. Don't rely solely on rumours. Use them as a risk overlay to your existing financial model.
Let's address some of the most common questions I'm seeing in comments and from viewers. First, should I remortgage now? If your current deal is expiring in the next 12 months, getting rate quotes now is a smart move. Locking in something you can afford may be safer than hoping for a sharp rate cut. Second, will my house lose value if these tax changes happen? That depends a lot on where you are and how expensive your property is. High-end London homes are more exposed. More modest properties, especially in commuter or regional areas, are less likely to collapse unless mortgage stress or unemployment kicks in. Third, is now a good time to buy? It depends. If you're buying for the long term and the numbers work under conservative assumptions, yes, this could be a strong opportunity. If you're planning to sell within a few years, or if you're very reliant on low mortgage rates, you may want to wait for more clarity, but only if you're not priced out by competing buyers. To wrap up, the 1.8% drop in Rightmove asking prices is a wake-up call. It shows that sellers are recalibrating and that uncertainty is real. The budget rumours are powerful, and not just speculation. They have the potential to reshape how property is taxed, bought, and held in this country. But that doesn't mean disaster is locked in. There are realistic paths forward for both cautious homeowners and bold investors. But the key is discipline, modeling, and preparation.
If this breakdown helped you, hit like, subscribe, and leave a comment. Do you think the Chancellor will deliver a hard budget shock or just a modest tweak? What are you planning to do? Sell, buy, or hold? I read all your comments, and I'll do a follow-up based on what you tell me. Thanks for watching. Stay tuned, stay informed, and make your next move with purpose.